effectively see myself as a serial entrepreneur in the power sector. As John mentioned, Dichotomy Partners, that's our value-oriented broad mandate fund. We basically focus in on the power industry. I'll dabble a little bit here or there outside of it, but there's enough to do. And I truly believe in sector specialization, just given the fact that you can generally get into the weeds a lot better. Plus, small shop, so no sense in trying to be everything. Just try to be good at one thing. Piggybacking on that, I mentioned to John, it was Elevate Power. It's actually Relevate Power now. We added a very expensive R on it to avoid trademark issues. That was formerly known as Dichotomy Power, which is a firm I founded. It's a IPP in the hydro sector. We actually just closed a large transaction. So our current megawatt hours per year is actually over 250,000 megawatt hours per year, 40 plants spread out in the Northeast. And then I've done tax equity, tax transfers, know enough to be dangerous, done various step-up vehicles, all that good stuff. So have enough knowledge in the power sector to be dangerous at any sort of cocktail hour that there is, but definitely, a lot to learn and a lot going on. With all this stuff, I think one of the questions I always get is, well, how do you focus? And my view is that the valuations of the public and the private sectors oscillate. And sometimes valuations are more attractive in the public markets, sometimes in the private markets. So you just kind of figure out where that opportunity is and adjust based on that. Above all else, I think you'll see in my slides, I try to have fun. Don't take yourself too seriously. We're all going to the same place anyway, so you may as well enjoy the ride and get a laugh along the way. Opportunity set today. I always like to frame this, just it's fun for me to do this on an annual basis just because I do it for annual letters, but then also, when I come here, I like to think through, what does the world look like going forward and everything like that. Right now, I think last year I wrote that public valuations were generally more attractive. This year, I actually think that's been inverted. IPPs, independent power producers, have gone on a tear. You can look at the recent announcement today of Constellation buying Calpine. Vistra's up, a ton. Just a lot of forward momentum in IPP land and multiples that are deservedly higher, but higher than historically. So it's kind of interesting to see those go, and really quite dependent on power curves remaining elevated and or load growth continuing on. Solar and wind, somewhat in value trap land right now. It's kind of interesting to see. Basically, there's a lot of unknowns regarding the new administration. Worldwide, there's challenges on getting enough power assets to the grid. And as a result, you're having, I think, distinct challenges getting a lot of these assets built. And so when I say private valuations, I'm more saying like projects that are built and ready to go. If you're a publicly traded IPP that has, solar or wind pipeline, you probably are going to have challenges getting connected. However, if you can get it connected, you're in a distinct advantage just given the increase in terminal value that's taken place. Then the final sector area would be utilities, UTEs as I'll call them. They're kind of all over the place from a valuation perspective, and I'll go through that in a little bit. But the key thing has been load growth. For basically 2008 until 2021, there was no load growth at all, actually negative. And now that's since inverted, mostly, not always, but mostly. So you see a lot of utilities, as this nice picture shows. Some utilities are going to be left in the dust, but you've got a lot of utilities if they have data centers being built out, if they have nuclear facilities, and then there's everybody else who's been kind of left behind. Last year, load growth and nukes pretty much ruled everything. And so if you owned a nuclear facility, you were rewarded handsomely. Some of the best performing utility stocks were those with large nuclear assets, either ones that they had ready to go or ones that they could bring back online due to repowering and everything like that. My view is that utilities offer a very interesting place right now, particularly those without nukes, just given the fact that load growth is real. And if you can hone in on specific areas, you're going to have I think, an interesting valuation setup and you're not too demanding of a forward look as a result. As I mentioned, utilities had a good overall year, and I sort of break them down into three buckets. So as I mentioned, you've got the nuke-focused utilities. So think of like Entergy, PSEG. And you can see on this chart here, if you look at Public Service Enterprise Group, PSEG, big nuclear facilities, probably the most dominant nuclear besides Constellation, but from a rate-regulated perspective, they own the most nukes overall. And they had a really good year. just kind of went up and to the right overall and outpaced the overall utility index. And we're pretty much in line with the movements for a lot of the independent power producers with or without nuclear facilities. It's interesting for PSEG because their load growth is okay, but it's definitely not the greatest by any means. Then you go down a step, you've got vertically integrated utilities. Some of them did, pretty good. Others kind of muddled along, but Duke, I'd say, is a good sort of example of that, where it's large, it's integrated, it has a lot of assets all over the place, and they had a good year, but they actually underperformed the overall utility index because they don't have that raw nuclear exposure, if you will. And then on the final side, you've got basically the transmission only utilities, and best way I could summarize it, you got a sad trombone noise where you've got Eversource had a tough year overall, negative return, underperformed the utility indice by probably about 30%, and everything was all said and done. There were some structural issues to say Eversource. We're going to pick on them, but even if you look at Consolidated Edison, which is transmission only in New York, they didn't really perform that well either. What's interesting about that is basically if you go back 7-8 years, maybe 10 or so, there was a big push by a lot of utilities to become transmission only. They all looked around and said, generation is not where we want to go. There's too much volatility. We have no interest being there. And so they basically got rid of all their generation assets and focused in on transmission only. At that point in time, transmission only was given a higher multiple. Executives were materially incentivized to ultimately focus in on that. And interestingly, now they're kind of being punished for it. And there's a few different reasons for that. If we look at longer term on the trends overall, though, I think this is going to be something that's important to think about. So just a quick kind of overview for utilities. Utilities have a regulated rate of return. They're considered a common good. So they're basically given a monopoly in any sort of territory, and their return on equity is decided by the Public Utility Commission. That return is going to be impacted by a lot of things, but primarily you're going to look at the spread between the 30-year treasury and the ROE that's given. So in periods where the 30-year treasury rises rapidly, you generally have some regulatory lag between the rate of the return on equity, the spread between the return on equity and the overall 30-year treasury yield, which is why you saw in like 21 and 22, those were relatively tough years for utilities, given the fact that rates were rising fast and they weren't able to go to the PUC and get those ROEs increased commensurate with the increase in overall rates. So the spreads ultimately compressed down a little bit, but I'd say they fell, somewhat within historical norms, not too far off. Nonetheless, that was a cause for some of the pain for a lot of these electric rate cases that went through. My view is that as we look forward, you're going to have a case for integrated non-nuke utilities. If you look at a lot of the independent power producers out there, I look at those as saying, okay, those are going to be significantly more correlated to power market prices, and ultimately higher power prices will equal more free cash flow, better earnings, all that type of stuff. For the integrated non-nukes, there's a little bit of a lag, but they're going to have similar overall characteristics with some good downside protection. These higher prices, though, will not flow down to the transmission-only utility companies, which are basically just going to be beholden to interest rates and already have their rate of return set in because they're transmission-only, and they don't have any quote-unquote fuel volatility within that. I think the interesting thing, though, if you kind of peel back a little bit, conventional assets, take like, coal, natural gas, nuclear for the most part, were largely pushed to the side for, call it the 2017 through 2021 era. And that was due to the fact that power purchase agreements were not very constructive. What we've started to see now, though, is that the marginal buyer of power purchase agreements, PPAs, has started to push up those contracts quite a bit. So there's been some noticeable announcements. Constellation announced they're bringing on 3 Mile Island at about $130 a megawatt hour. Millstone in New England is putting a 1.2 million square foot data center next to it, and that's going to have a material increase in the overall power purchase agreement price that they have. And even wind and solar, you're starting to see PPAs rise up a little bit more overall. And so generally, you're starting to see prices rise $10 to $30 per megawatt hour, although that can be higher for some nuke assets, lower for some conventional assets, and in between for solar and wind, depending on where they are. For utilities, this is interesting because basically now they're going to be able to invest more in assets, particularly those in the integrated space. They're going to have more opportunity to invest in assets, whether it's transmission, whether it's distributed generation like solar and wind, or whether it's conventional assets like combined cycle gas turbines or something like that. Also interesting, if you look at what has taken place in the capacity market, there's been sort of this big shift change in how capacity markets calculate returns for a lot of different assets. The big shift is that marginal ELCC. And for all the people listening to this, this is going to be acronym hell, but ELCC is effective load carrying capability. And it's how the ISOs, the independent service operators, rate individual assets and their ability to send capacity to the grid when needed. And I think the interesting thing about this is marginal ELCC. To summarize a technical concept very quickly, basically what it does is it starts to penalize assets that bring on more of the same types of technology. So if I have a grid that is made up of one solar asset, one nuclear asset, and one combined cycle gas turbine, you could say, okay, well, all three of those are not going to be correlated because you're going to have nuke fuel when you don't have gas. You may have wind when you don't have, natural gas going on, maybe nuclear, whatever it may be. However, if all of a sudden I put two new renewable facilities in that and I keep the same thing going, the additional renewable facility in that grid is going to bring less value because it's going to be correlated to the other assets that are there of the same technology type. So in that hypothetical example, if I have, before marginal LCC, I have one solar, one nuke, one CCGT, capacity for all intents and purposes is split equally across those three. If I add two solar, and so I have two solar, one nuke, and one CCGT, now all of a sudden that solar is going to be given maybe the same dollar amount, but it's going to be spread out over two assets. So what that does is it drives down the capacity prices for the specific asset, but starts to raise it for the other assets. What's that done? Well, that's resulted in higher capacity prices. If you're a transmission only ute, the difficulty is how do you really take that into overall account? And the truth is you can't. At the end of the day, they just have to more or less pass that cost on. And this becomes a real big contentious point for the Public Utility Commission and everything that they have to factor in, because they're going to be fixated on cost to the consumer and not necessarily, thinking about, well, how's it being shouldered? If I'm a integrated utility, though, I am going to have those generation assets. So I will be receiving revenue for those generation assets. And then ultimately, I can pass those costs. I can absorb those costs because those generation assets are already there. So it's an interesting sort of dynamic in which the integrated utes are going to be less exposed to these price increases because they're able to shoulder those costs on their own generation assets, versus transmission assets, transmission only utilities are going to basically be exposed to it, and they just have to pass those on. So every time they go to the PUC, they're going to have to explain why capacity prices are high. They're going to have to pass those through. And interestingly, the thing they were trying to do, which is avoid the large fuel cost volatility, they're actually now directly exposed, but in a different way. So it's an interesting dynamic that I don't think has been fully factored in. And certainly, I think will play out over the next few years as capacity prices increase and as load starts to grow a little bit more. Which brings me to our idea, Portland General.